Welcome to the Byte-Size Brief. Today we are putting Anheuser-Busch InBev SA, BUD, that's B-U-D, completely under the microscope. Let's get into it.
I'm very ready for this one.
Awesome. So I want you to imagine for a second that you are running a business, right?
Okay, picturing it.
And over the course of an entire year, you actually sell millions of fewer physical products than you did the year before.
Right, which usually means panic mode.
Exactly. Logically, you would expect your profits to just take a massive hit.
Hmm.
But what if, despite selling, significantly less product, you somehow managed to post the highest profits in your company's entire history?
It sounds like fake math, honestly.
It totally does. But that is the exact paradox we're looking at today with Anheuser-Busch InBev SA BUD and their full year 2025 and Q4 results. Falling volume, but rising profit. It basically feels like a glitch in the matrix.
Yeah, it's not a glitch, but it is a massive structural shift for them. To understand how BUD is pulling off this financial magic trick, you really have to look at the historical baggage they've been carrying for, well, a decade.
Right, the SABMiller deal.
Exactly. If you go back to 2015, they executed this colossal acquisition of SABMiller, and, it made them the undisputed king of global beer.
But at a steep cost.
A ridiculously steep cost. It saddled them with a mountain of debt. So for the last 10 years, almost every spare dollar has been funneled into just paying down that debt.
Keeping the lights on and the creditors happy.
Yeah. What makes 2025, and specifically this Q4, so pivotal is that for the first time since that deal, the debt anchor is finally light enough.
Wow.
They can stop playing pure defense, and they're finally pivoting toward massive shareholder returns.
Okay, so compared to last quarter, what actually moved the needle here?
Well, it really comes down to sequential momentum. The narrative around BUD was incredibly grim earlier in the year.
Oh yeah, people were bailing.
They were. If you look at the first half of 2025, total global volumes were down by a very scary 8.6%. Investors were hitting the panic button, assuming the bottom was just falling out of the global beer market.
Which is a fair assumption when you see an almost 9% drop.
Totally fair. But you have to look at the trend line. By the fourth quarter, that volume drop had narrowed to just 1.5%.
Wait, let me stop you there. Because a 1.5% drop is still, a loss. You are still shrinking. How does a company shrink by 1.5% in a quarter and still trigger what the market is calling a massive earnings beat?
Because Wall Street trades on expectations versus reality, right? The market had priced in a disaster based on that 8.6% drop from earlier.
So less bad is actually good.
Exactly. When Q4 came in at only negative 1.5%, it proved the bleeding had largely stopped. And because they stabilized that volume, the financials underneath were able to finally shine through.
The actual profitability.
Right. They posted earnings per share of 95 cents, which cleanly beat the $1.89 estimates, and they brought in revenue of $15.55 billion for the quarter.
And when you stretch that out to the full 2025 fiscal year, the profitability metrics are what really jump off the page.
The EBITDA numbers are wild.
They are. Overall, normalized EBITDA jumped 4.9% to a staggering $21.2 billion. But the metric that really caught my eye was their profit margin expanding by 101 basis points.
Yeah, that's the real engine here.
Right, and let's translate that basis point jargon for the listener. Because for a $59 billion behemoth like Anheuser-Busch InBev SA, BUD, expanding margins by a single percentage point might not sound like front-page news.
But in physical terms...
In physical terms, that means they are squeezing hundreds of millions of dollars in extra profit out of the exact same vats of beer.
Precisely. And that margin expansion acts as the catalyst for the most critical metric in this entire deep dive, which is their net debt to EBITDA ratio. At the end of the year, that ratio officially dropped to 2.87x.
Which is a huge psychological threshold, right? Breaking below that 3.0x mark is what gives management the green light to open the wallet.
It changes everything. It proves the deleveraging era is effectively over. The second that ratio dipped below 3.0x, it triggered management to announce a massive $6 billion share buyback program.
And a 15% dividend hike.
Right. They are directly returning that hard-earned cash to the shareholders now because they no longer have to feed it to their creditors.
So basically, it's kind of like a restaurant, raising menu prices so much that even with fewer customers walking through the door, the cash register is actually fuller.
It's a useful way to visualize it, but I do have to push back a little on the idea that they can just keep hiking prices indefinitely.
You mean there's a limit to what people will pay for a beer?
Exactly. Pricing power has a ceiling. You cannot just take a standard core beer, slap a 20% price increase on it every year, and expect consumers to keep swallowing it. Demand destruction is a very real threat.
So how are they getting around that ceiling?
What Anheuser-Busch InBev SA BUD is doing relies heavily on a mechanism called premiumization.
Meaning they aren't just making the cheap beer more expensive, they are actively convincing people to buy the expensive beer instead.
Exactly that. They are intentionally shifting their marketing dollars and their consumer focus toward higher margin premium brands within their portfolio.
Brands like Stella Artois and Corona, right?
Right, because the physical cost to brew a bottle of Stella is not drastically different from brewing a standard, everyday lager. But the retail price you can charge is significantly higher.
So the gross margins on those super premium brands are just immense.
They are. That is the actual mechanical engine allowing BUD to extract more profit from less overall liquid volume.
Okay, that structural shift makes sense. But premiumization is only financial armor if the consumer is actually willing to pay up.
And able to pay up.
Right. And when we look at the regional map, that armor has some massive glaring vulnerabilities depending on what border you cross.
Oh, absolutely.
It feels like they are playing a global game of whack-a-mole. You look at Middle and South America, and they're absolutely surging. Colombia just hit record-high volumes with double-digit bottom-line growth.
Mexico is doing incredibly well, too.
Yeah, Mexico's showing mid-single-digit growth, actively taking market share from competitors. But then you look east, and the wheels are falling off.
We definitely cannot ignore the massive red flags, specifically in China. The hard data from the fourth quarter shows a brutal 15.2% revenue drop in the Chinese market.
A 15.2% revenue drop for a company this size is just staggering. What is the actual mechanism causing that? Is it just that people in China suddenly hate the beer?
No. It is fundamentally a macro inventory issue tied to the broader economic slowdown in China right now.
Like a clogged pipeline.
Basically, yeah. Consumer confidence in China has plummeted, meaning fewer people are going out to bars and restaurants. Because the end consumer isn't buying, the distributors and wholesalers are stuck with massive stockpiles of unsold BUD sitting in their warehouses.
Oh, so they can't even take new orders.
Exactly. Until those distributors sell through their existing inventory, they aren't going to order fresh shipments from Anheuser-Busch InBev SA BUD. The pipeline is backed up, and it completely strangles revenue.
And China isn't their only headache. The United States is still a massive, complex puzzle for them.
The lingering U.S. issues are significant.
Yeah. As of late January 2026, Bud Light volumes are still down nearly 30% year over year. That is a brutal, lingering hangover from the 2023 boycotts.
But here's where it gets really interesting for anyone analyzing their corporate strategy. They didn't just sit there and take the loss.
Right, they pivoted.
They used Michelob Ultra to aggressively offset the Bud Light collapse. They pushed it so hard that Michelob Ultra actually took the #1 volume spot in the U.S.
They basically orchestrated a controlled cannibalization of their own struggling brand with a premium alternative from their own portfolio.
It is a textbook example of why having a deeply diversified brand portfolio is a defensive moat. If they only sold Bud Light, that 30% drop would be an existential crisis.
But because they could pivot marketing dollars instantly to Michelob Ultra, they captured the very consumers who were fleeing their core brand.
Keeping that money inside the Anheuser-Busch InBev SA BUD ecosystem, however, brilliant pivoting aside, structural weakness in China and core brand struggles in the U.S. remain severe headwinds.
Hold on. How does a 15% drop in China and a 30% drop for Bud Light actually affect Anheuser-Busch InBev SADUD stock price for regular investors like me? Can you really just whack-a-mole your way to growth?
It is a completely fair skepticism. You can't just ignore double-digit revenue craters. But remember what we discussed earlier about Wall Street trading on the derivative, the rate of change?
Right, expectations.
What the market is reacting to isn't that China is doing well, but that the data shows their market share in China actually stabilized in Q4. It trended flat year over year.
Oh, okay, so it proves to institutional investors that they have finally found a floor.
Exactly.
So the bleeding hasn't stopped, but they've got a tourniquet on it.
Precisely. But there is another layer here that rarely makes the headlines, and it's a silent killer for the specific stock: currency fluctuations.
FX drag.
Yeah. Anheuser-Busch InBev SA BUD is a global giant, but they report their earnings in U.S. dollars. Right now, their massive growth engines are in countries using the Brazilian real, the Colombian peso, or the euro.
And the dollar is strong right now.
Very strong. So when the U.S. dollar is exceptionally strong, the money they make in Brazil literally shrinks when they convert it to report to U.S. investors.
Let me make sure I'm following. You're saying they could sell, say, 10% more beer in Brazil, make 10% more Brazilian reals, but because of the exchange rate, it looks like a 0% gain on Wall Street.
Worse than zero sometimes. In fact, the recent data shows they actually achieved 2.0% organic revenue growth globally.
Meaning physical sales and local pricing were up?
Yes, but their reported revenue was actually down 0.8% entirely because of negative currency translation. It acts as an invisible tax on their global success.
That has to be incredibly frustrating for management. I mean, if core beer volumes are under pressure globally and currency exchange is just eating your organic growth, it forces us to look under the hood at exactly how they are defending these expanding profit margins.
They have to get creative.
Right. If they can't rely on selling more volume, they have to manipulate the supply chain. And the sources show they're making some incredibly aggressive under-the-radar moves to do exactly that.
The most critical move happened just recently. In January 2026, Anheuser-Busch InBev SA, BUD, spent $2.9 billion to buy back a 49.9% stake in U.S. metal can plants from Apollo Global Management.
Wait, $2.9 billion. Why tie up nearly $3 billion in an aluminum factory instead of pouring that into marketing or new product development? Explain the mechanism there.
It is a masterclass in vertical integration. By owning their packaging production outright, rather than contracting it out to a third party, they gain absolute control over their supply chain.
Because the can itself is a huge expense.
The cost of the aluminum can holding the beer is just as vital to their profit margin as the liquid inside it.
Yeah.
In an era of unpredictable commodity pricing and inflation, owning the factory removes the middleman's markup.
So it acts as a massive defensive moat, insulating their premium margins from sudden spikes in packaging costs.
Exactly.
Okay, so they're locking down the physical supply chain to protect margins. But they're also digitizing the sales side of the business to strip out operational costs. We have to talk about BEs.
The B2B platform.
Yes. This is their proprietary B2B tech platform, and the numbers are just exploding. Gross merchandise volume, which is the total value of goods sold over the platform, grew 61% to $3.5 billion.
That's a massive shift in how they do business.
They are completely digitizing their relationship with wholesalers and retailers.
The efficiency gains there are staggering, honestly. Think about the legacy model. You have thousands of sales reps with clipboards driving around to individual bars and liquor stores.
Taking inventory, writing orders by hand.
Right, and hoping the bar owner is actually there when they show up. It is highly inefficient.
So basically, BEE is like the Amazon Prime of distribution, and Corona Cero is their insurance policy against Gen Z sobriety.
Well, wait, let's unpack that because those are two different but equally massive pivots.
Yeah.
With Bees, instead of waiting for a sales rep, a local bar owner in Bogota can just tap an app at 2 a.m.
Use predictive algorithms to order exactly what they need for the weekend.
Right, and the company locks in that sale with almost zero human overhead. It increases order frequency, reduces out-of-stock scenarios, and drastically cuts the administrative cost.
Okay, so that's BES. But let's get back to the second half of my analogy about the product mix shifting and Gen Z's sobriety.
Yes, looking at what they are selling. If we look at their Beyond Beer category, the growth is jaw-dropping. Their no-alcohol segment saw massive 34% growth globally.
And specifically, Corona Cero grew by an astounding 75% compared to the previous year.
A 75% jump for a non-alcoholic beer is wild.
It is. But it tracks with the broader cultural data. Recent Nielsen EQ metrics and Gallup polls clearly show that younger demographics, especially Gen Z, are actively prioritizing health and wellness.
They're drinking significantly less alcohol than millennials or Gen X did at their age.
Exactly. In fact, a majority of Americans now report viewing even moderate drinking as harmful.
Which is a terrifying macro trend if your entire business model relies on selling alcohol.
Right, but what does all that actually mean for Anheuser-Busch InBev SA BD investors? If the core product is literally falling out of favor with the next generation of consumers, isn't that a slow-moving death sentence?
Not if you control the distribution. This is exactly why Anheuser-Busch InBev SA BUD is relentlessly pushing zero alcohol options and ready-to-drink cocktails.
They see the writing on the wall.
They are recognizing the threat and cannibalizing themselves before an upstart competitor can. They are taking their massive, unmatched global distribution network, the trucks, the shelf space, that BS platform, and using it to dominate these new, sober, curious categories.
Because they have the logistical scale to put Corona Cero on every single grocery store shelf and bar tap in the world almost overnight.
A local craft non-alcoholic brand simply cannot compete with that level of market saturation.
So back to my point, Corona Cero is their insurance policy.
Mhm.
They are locking in the retail ecosystem so that no matter what the consumer wants to drink alcohol or not, the profit still flows back to BUD.
That is the strategy in a nutshell. Defend the margin at all costs while consumer habits evolve.
Okay, so we've torn apart the financials, we've looked at the geographic weak spots, and we've explored their vertical integration and product pipeline. Let's bring this entirely into the present.
Let's do it.
What is the catalyst? What is actually going to move this stock right now in 2026? Because there is a massive bull case building, and I am incredibly hyped about it. The upcoming 2026 FIFA World Cup.
It is undeniably the most heavily watched sporting event on the planet.
And it is being hosted right in their backyard across the U.S., Canada, and Mexico. Anheuser-Busch InBev, S.A., BUD, is the official beer partner. They aren't just running a few commercials, they are rolling out massive global marketing campaigns.
Featuring absolute legends.
Yeah, Lionel Messi and Neymar across 70 different countries. For a company that relies heavily on momentum in the Americas, a North American World Cup is going to be a monumental catalyst for second half 2026 volumes.
It's a huge event for sure.
The big money sees this too. Morgan Stanley just recently upgraded their price target to EUR 74, specifically pointing to this massive marketing tailwind combined with the new shareholder returns.
I will concede that the World Cup activation will provide a strong, temporary volume tailwind. But as an analyst, my job is to look at the structural risks.
Uh-oh, here comes the cold water.
I have to throw some sharp cold water on this hype. You cannot invest purely on the excitement of a one-month soccer tournament. We must evaluate the bear case.
Okay, lay it on me.
While Morgan Stanley is upgrading, SBG Securities recently downgraded Anheuser-Busch InBev SA, BUD, to a hold, and there are underlying financial metrics that justify that caution. For instance, their Altman Z-score currently sits at 1.49.
Whoa, stop right there. The
that?
Altman Z-score. For listeners who might not be deep in the financial weeds, isn't that a formula specifically used to predict the likelihood of a company going bankrupt?
It is, yes.
Are you actually suggesting a $59 billion global staple is at risk of going under?
Let me be absolutely clear. They are not going bankrupt tomorrow. However, we have to respect the math.
Fair enough.
The Altman Z-score measures working capital, retained earnings, operating income, and leverage to gauge overall financial health. A score of 1.49 places them firmly in the gray zone.
Which technically flashes a financial distress warning.
Right. It acts as a sober reminder that while their debt ratio has improved, this is still a highly leveraged company operating in an environment where the broader craft beer segment is struggling.
And raw operating costs are still high.
Exactly. And consumer discretionary spending is incredibly tight.
I hear you on the Z-score, and I respect the math. But man, if you look at the actual market momentum, the tape tells a completely different story.
You think so?
Absolutely. Beer stocks broadly are currently breaking out across the sector. Anheuser-Busch InBev, SA, BUD, specifically has a Zacks rank of number 2, which is a strong buy.
Driven mostly by multiple expansion, though?
Right, multiple expansion from a notoriously low base. The stock was historically beaten down for years because of that SABMiller debt overhang we talked about.
Yep.
Now that the fundamentals are stabilizing and the buybacks are starting, institutional money is rotating back in. It is a classic breakout setup. You buy the stabilization before the World Cup hype fully prices in.
I don't disagree that the technical charts look strong at this exact moment, but I will counter your momentum argument with the valuation reality.
Okay.
You mentioned multiple expansion. The stock is currently trading at a price to earnings, or PE, ratio of around 21. Think about what that actually means.
Well, 21 isn't crazy for a consumer staple.
For a mature, slow-growth consumer staple company that is actively losing volume, paying 21 times earnings is not exactly a bargain. It strongly suggests that the market has likely already priced in the recent Q4 earnings beat.
And the $6 billion buyback excitement.
Exactly. Because they are sitting at that relatively high multiple, there is a very real possibility the stock might just trade sideways.
Just consolidating these recent gains?
Yeah, consolidating until the World Cup actually kicks off and they prove they can drive real, sustainable volume growth in.
That is the ultimate tension for anyone looking at this stock, right?
Right.
You have undeniable momentum, massive sporting catalysts, and brilliant supply chain engineering.
Going head-to-head against a premium valuation and deep structural volume concerns in major markets like China and the U.S., which really leaves us with one final crucial question to consider before we wrap up.
What's that?
If the secular decline in global alcohol consumption outpaces their premiumization strategy, meaning if Gen Z simply stops drinking beer faster than the company can convince older generations to trade up to more expensive beer,
Right.
will Anheuser-Busch InBev SA BUD's massive $6 billion share buyback be enough to artificially prop up their earnings per share, or is it ultimately just financial engineering masking a shrinking foundation?
Oof. That is the million-dollar question for anyone holding this stock in their portfolio right now. The financial maneuvering is masterful, but shifting consumer habits remain the ultimate wild card. All right, listeners, what's your take on the future of Anheuser-Busch InBev SA? BUD. Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.